Today we're diving into Karman Holdings Inc., a really key player in aerospace and defense. They specialize in these mission-critical systems, things like payload protection, propulsion, basically the sharp end of missile and space tech.
Right. And the big question we're tackling is pretty stark. Karman's operational growth is, well, impressive. Strategic position seems strong. But does any of that actually justify this incredibly high stock valuation we're seeing?
Exactly. And I'll be arguing that yes, it does. I think this valuation is forward-looking. It's pricing in the company's potential as a genuine technological disruptor in critical defense areas.
And I'm taking the, let's say, more skeptical view here. That operational story, compelling, absolutely. But the current numbers, the valuation metrics, they seem fundamentally untethered from profitability right now. And that, creates some serious potential downside risk. We really have to ask if any company, especially one this young, can realistically execute perfectly enough to earn this kind of price tag.
Well, okay, let's frame this correctly. We're not talking about some, traditional slow-moving defense contractor here. Karman Holdings is deeply involved in the absolute cutting edge, the high-growth segments, hypersonics, strategic missile defense. These are national priorities. So the valuation isn't really about old assets. It's about technological speed and, frankly, necessity. And look at the evidence, the operational proof points. They hit record earnings in Q3 2025. Quarterly sales growth, over 43%. That's huge.
Mm-hmm.
And maybe more importantly, analysts are forecasting truly explosive earnings growth. We're talking something like 117% EPS growth over the next 5 years. You're essentially seeing a tech multiple being applied here, but to a company with near monopoly status in certain defense niches. And crucially, they've got this record-funded backlog, over $750 million. That gives them, better than 90% visibility on revenue streams, way out into the future. Plus, their strategic buys like MTI for those specialized refractory alloys, that's just deepening their technological moat.
Okay, that is a powerful narrative. I grant you that. But it feels like it's built almost entirely on the expectation of flawless future execution. We have to ground this discussion in, today's financial reality. And the stock's current metrics, honestly, they're staggering and potentially quite dangerous for investors. The trailing price-to-earnings ratio, it's sitting above 800. The price to sales is around 21.
Uh-huh.
Now, just for context, the average for the aerospace and defense industry is a PE around 43 and price to sales about 3. So Karman Holdings is trading at nearly 19 times the industry average PE. That kind of price implies the market expects, decades of perfect explosive growth. That seems like an incredibly bold assumption for a company founded just in 2020 and only went public early in 2025. And adding to my concern here, remember that in Q3 2025, despite that strong revenue number you mentioned, Karman Holdings actually missed its bottom line profit estimates. That suggests this hyper growth might already be straining profitability.
Yeah, that 800 plus PE ratio, that's really the elephant in the room, isn't it? It just demands extreme scrutiny.
I mean, when Karman Holdings' trailing 12-month profit margin is so thin, just 2.65%, and their cash per share is basically nominal, $0.14, how much faith can we really put in a forward growth rate that seems so vulnerable to any slip-up in execution? A multiple this high suggests they need to scale earnings by factors of 10 or 20 and fast.
That trailing multiple is always going to look distorted for a hypergrowth company like Karman Holdings. They just had their IPO, they're investing heavily in expansion, integrating acquisitions. Of course, the past 12 months' earnings aren't going to reflect the future potential. The market isn't looking backward, it's looking forward. And that's precisely why that projected 117% EPS growth rate over the next 5 years is the crucial factor driving investor confidence right now.
But isn't that growth rate, especially when you pair it with the current price, exactly why this valuation becomes so, mathematically questionable? Look at the PEG ratio, the price earnings to growth. It's roughly 6.9. Now, generally a PEG over 1 suggests a premium is being paid for growth. But 6.9? that implies the market believes Karman Holdings can keep up this insane growth rate for years longer than seems even remotely realistic, especially in a sector like defense that involves heavy manufacturing. I get paying a premium for, say, a software company that can scale with near zero marginal cost. But can a company that actually makes complex things like refractory alloy systems really sustain that kind of scaling without hitting major manufacturing or supply chain bottlenecks? And wouldn't that invalidate the premium multiple you're talking about?
But the reality is, the systems Karman Holdings builds are technologically unique. They've already overcome huge barriers to entry, regulatory hurdles, IP protection, defense certifications. These are significant moats. This isn't like making widgets. It's not a commodity business. And they are acquiring strategic assets, like 5-axis, specifically to address potential bottlenecks and expand capacity. So yes, the market is paying a premium, absolutely. But it's paying for what looks like a technological monopoly in areas absolutely critical to national security modernization, non-negotiable areas. Look, even if they only hit, say, 50% EPS growth instead of 117%, they'd still be massively outperforming the sector. And over time, that valuation risk naturally starts to diminish as earnings catch up.
Diminishes, perhaps, but maybe not quickly enough. And the sheer necessity of that staggering growth to justify the price, well, that brings us right to the financial structure needed to actually fund it.
Well, okay, let's look at the balance sheet. From a liquidity perspective, it suggests strength, which is obviously vital if you're going to maintain this kind of growth pace. Their quick ratio is up at 2.69. The current ratio is 2.86. These numbers indicate pretty robust liquidity. Karman Holdings seems to have more than enough accessible assets to cover its immediate obligations. That gives them flexibility, allows them to keep investing without hitting a panic button.
That liquidity figure is just a snapshot, though, and I think it kind of hides the real cost of this ambition. Because this expansion has clearly put a strain on their finances. You look at the leverage, the debt-to-equity ratio is 1.31. Now, a DE ratio over 1, especially for a young public company trading at these kinds of multiples, that usually signals potential instability. This level of debt, combined with those thin trailing net margins we talked about, means that any future capital they need to sustain that 117% EPS growth target, whether it's for more CapEx or other acquisitions, is probably going to be highly dilutive to existing shareholders. You pointed out a strong gross margin, nearly 33%, which is good, but the net profit margin is stuck way down at 2.65%. That huge 30-point gap, it suggests significant efficiency problems or maybe just excessive overhead costs as they try to scale up so fast. That puts immediate pressure on their ability to actually deliver those extreme bottom line forecasts everyone's banking on.
Okay, but the acquisition integration fees, the heavy investment in scaling up their operational base, those things are naturally going to depress the trailing 12 months net income. That's simply the cost of building a significant technological lead in this space. The long-term efficiency gains, hopefully, will come from the strategic value of those acquisitions, like 5-axis industries. They aren't just buying revenue streams. They're buying specialized capabilities that very few competitors possess.
All right, let's pivot that argument slightly and look at their market role, but through the lens of risk. You mentioned their unique position, but the reliance on sole source or single source contracts, I think the figure was around 87% of 2023 revenue. While that definitely shows a strong competitive moat, it also concentrates risk to what seems like an uncomfortable degree. This heavy dependence purely on U.S. government spending exposes Karman Holdings directly to the inherent volatility of defense budgets. Shifts in political priorities, long procurement cycles, any of that can throw a wrench in the works. If just one of their major programs gets delayed, or worse, canceled, the fallout for a stock price for absolute perfection could be, frankly, catastrophic. That record backlog you mentioned, impressive, yes, but it's only as secure as the political will that keeps funding those specific contracts.
Sure. The risk of government spending fluctuations is real. It exists across the whole industry. But the flip side of that 87% reliance is just sheer market validation of their specific technology. They specialize in systems for top priority, absolutely mission-critical programs, hypersonics, strategic missile defense.
These are not discretionary spending items that get cut when budgets tighten. They are foundational elements of the nation's deterrence strategy going forward. So, being a sole source supplier in these critical niches actually generates incredibly sticky revenue. It means their systems are so specialized, so embedded in these programs, that they simply cannot be easily swapped out. That $750 million backlog isn't just good revenue visibility. It's proof of an almost irreplaceable, highly defensible market position. In a way, they're insulated from typical competition precisely because their main customer literally can't afford for them to fail on these programs.
I agree the revenue is sticky, yes, but that very stickiness seems married to extreme price volatility. I mean, just look at the recent news. The stock dropped over 4% in a single trading session just yesterday, November 11th. That's a perfect example of what happens when a stock carrying an 800 PE ratio runs into even minor disappointment or just general market jitters. The downside risk feels immediate, sharp, and severe. It makes the whole investment case seem incredibly brittle.
Well, volatility is kind of the natural result when you have this immense growth potential meeting the inherent structure and cycles of the defense sector. The market is assigning this premium because Karman Holdings has shown it can achieve a kind of agile technological leadership that the bigger, more entrenched defense giants, often hampered by legacy systems, struggle with. So the core debate really remains. Can they successfully bridge that gap between their current financial picture and the kind of hyper-growth that's implied by this sky-high valuation?
Yeah, Karman Holdings really presents this genuinely fascinating conflict, doesn't it? Between the strategic opportunity, which is clear, and the need for financial discipline, which seems stretched. We absolutely acknowledge the momentum, the tech moat is real, the potential for exceptional growth is there. However, that valuation just looms large. It's a massive overhang. Investors have to critically weigh that potential for, 117% annualized EPS growth against a PE multiple that essentially demands years and years of flawless execution. Any failure to meet those incredibly high expectations, whether it's in improving margins, integrating acquisitions smoothly, or just maintaining budget stability for their key programs, is likely to be met with severe price volatility. We're seeing that play out daily.
And I clearly see the risks, particularly inherent in the limited operating history as a public company and the high leverage they've taken on to scale this quickly. Yet Karman Holdings is positioning itself as really an essential cornerstone in modernizing national security and also enabling the commercial space economy. The market is assigning what feels like a generational premium to its unique technological role and that high revenue visibility from the backlog and sole source deals. The operational achievements they've racked up so far, record revenue, record backlog, strategic scale-up, they suggest that while the valuation is definitely stretched based on trailing earnings, the narrative for continued long-term growth and maybe eventual justification of this tech-like multiple remains compelling.